Hello, everyone, and welcome back to the second season of the online Cryptonary course. Now, this season is all going to be about technical analysis. You've certainly seen it or heard of it, and it's certainly the most used tool in crypto. Now, first off, we're going to start out with this quote. The reason being is that this quote is basically what technical analysts live by, right? The past doesn't repeat itself, but it often rhymes. In other words, there are certain patterns that we're able to identify in the past, apply to the present, and hopefully make money in the future. Now, what is technical analysis? It's basically, it's a tool that's used by traders and investors sometimes to determine the probability of a certain price action scenario based on trends and patterns. Now, the basics of this discipline always boils down to supply and demand. Technical analysts, they determine supply and demand levels from which price could react, as well as patterns that are showing strength or exhaustion of buying or selling pressure. Now, these are then used to build a plausible price projection with specific invalidation points, aka stop losses, in order to take a position in the market and generate profits. Now, in order to understand how these patterns form and where these key levels are derived from, I think it's very necessary to have a clear image of what a price chart represents. Well, I assume that most of you have not traded in pits, neither have I, and I think this has created a sort of disconnection with what the charts actually mean, what's behind these charts, right? At the end of the day, these charts are nothing more than data that's plotted over time, and that data is a representation of every single past action ever taken by every single market participant. In other words, a price chart represents the supply and demand of a certain asset over time. Now, with the acquisition of enough data, technical analysts, they believe that they're able to determine which prices are considered a bargain, and which prices are expensive, right? So which prices are oversold or overbought. Now, mainly, technical analysis employs three different philosophies. The first one being that price discounts everything, meaning that whatever news event or other fundamental information is already expressed by the price, right? The second one is that unlike the random walk theory, according to which prices are random, obviously, it assumes that past prices and movements can help determine future prices, right? So you can determine patterns in the past, apply them in the present, make money in the future, just like the first quote. The third one is that price action is always moving in a trend, and that trend can be different on different time frames. We could be on an uptrend on the weekly, but in a retracement, sort of a downtrend, on the daily. There are three main theories in technical analysis, or three main schools of thought that people adopt. First of which is Dow theory, and honestly that's the most important one because that's the very foundation of technical analysis. Now, this one is based on editorials that were written by Charles Dow, who happens to be the founder of the Wall Street Journal, as well as the Dow Jones Industrial Average. Now, although this theory was developed based on two indices, the principles can be applied to the cryptocurrency market. Now, there are several components to it. One is the efficient market hypothesis, which basically is that price discounts everything. Number two, you have market movements, and that there are three types of trends, and these trends vary in time frames. First is the primary trend, which the Dow theory assumes cannot be manipulated, and this one can last from a few months to a few years. Second, you have the secondary trend, and that one tends to deceive people because it's considered a corrective move from the primary trend. Now, this one can last from 3 weeks to a few months. finally, we have the daily fluctuations, and they're rather unimportant compared to the primary and secondary trend, and they can be simply considered as noise. Now, then you have also the stages of primary trends, right? These come in 3 different stages, and that goes for both bull and bear markets. In a bull market, the first phase is accumulation, where the majority of people remain pessimistic and the move is causing disbelief in the public. They're not trusting that this is a reversal, basically. Then you got the second stage, and that's the big move. And that one typically lasts the longest. And that's when most people get involved. Then you have the excess phase, and that's when prices are just extremely overvalued. Everyone is very bullish and throwing money everywhere. And that was what was happening in December 2017. And in a bear market, it's similar, but these stages are called distribution, big move, and despair. Number 4, and that one is very important, is that volume must confirm the trend. Now, the primary trend has to be, assume we're in an uptrend, with the up moves, you want to see increasing volume and you want to see decreasing volume on retracements, because that means that shows consensus from the majority of the capital in the market that they agree that the current direction must be up. In an uptrend, same can be applied to a downtrend. Number 5, and the final point, is that a trend remains until reversal signs shows. And you can determine that based on either a set of moving averages or volume characteristics. And the market structure, of course, lower lows, lower highs, etc. Now, there are 2 other less popular theories. First one being Elliott wave theory. It was developed by a guy called Ralph Nelson Elliott in the 30s, and it relates investor psychology to price action, and it considers every move to be either an impulse or retracements, and you'll see those counts, the 5 wave count and the ABC correction moves. Now, that's Elliott wave theory. You also have Gann analysis. This one is very geometric, a lot less common as well, and it studies time precisely. For us, the main school of thought that we have adopted is Dow theory, and that's what we're going to be using for technical analysis, and this season in particular. Now, before we continue to the next episode, there are a few limitations to technical analysis that you should be aware of. Now, number 1, that's obvious. The lower the liquidity, the less reliable the analysis is. And that's an issue in the cryptocurrency market because you have many illiquid assets, especially the small caps. You'll see a lot of wicks everywhere, very easily manipulated. So TA will not be as reliable as it is for Bitcoin, for example. Number 2, and that's a very common limitation, is the disagreement between analysts. I mean, just go on crypto Twitter and you'll see opinions left, right, and center, and very different opinions. Even for the same trader, right? You might show him a chart one day, tell him, plot me the key levels. Day 1, he'll plot them somewhere. Then you come back to him with the same chart a year later, and he'll plot different levels. And that's particularly an issue if the opinion or analysis changes very often. So if you open a trade on a certain analysis, then mid-trade you change your analysis, that's gonna lead to a disaster, most probably. But there is a cure to that we will be talking about soon.